Okay, let's do this question. This is Dinla company. Weighted average cost of capital. Requirement is calculate the after-tax weighted average cost of capital of Dinla company on a market value basis. This is the question. Ordinary shares 23 million, 5% preferred share 5 million, 6% loan notes 11 million, bank loan 3 million. Requirement is calculate the after-tax weighted average cost of capital. Okay, so let's do this question. Okay, so we have ordinary shares, preference shares, loan notes, bank loan. Okay, so sources of finance, ordinary shares, we have 5% preference shares, 6% loan notes, and bank loan. Okay, and cost of capital and market value, and we can do total. Okay, okay, so now let's do the market value. Market value is number of instruments multiplied by market price. So first we have to calculate the number of instruments, which is in this case the number of shares, the number of ordinary shares. Total share price given is 23 million. Nominal value of share is given 25 cents per dollar, so we can just do it like this. 23 million in common, we are taking million in common, divided by, so total share price given is 23 million, we are dividing it by nominal price of per share, which is 25 cent per share, and multiplied by market price 4.26, and we have the market value. And we can also let the examiner know we're taking million in common, and we're cost of capital in percentage. Okay, so now cost of capital. So nominal value is given, growth rate is given, and market price is given. So we can now calculate cost of capital of ordinary shares. So nominal price into, we are getting 4% growth every year 1 plus 4%, and we can divide it by our market price 4.26, and 4% growth 10.10%. Okay, so let's just calculate the total, which is market value multiplied by cost of capital. This is the total. We can just drag, because we have to calculate the rest, and it will automatically show here, so it will save time. Okay, now preference shares. Let's see the question. 5% preference shares have an ex-dividend market value of $0.56 per share and nominal value of $1 per share. These shares are irredeemable, so we have perpetuity in this case, but this is for cost of capital. Let's calculate the market value, which is same as ordinary shares, number of instruments multiplied by market price. So let's see, preference shares is 5 million, so let's take 5 in common and divide it by nominal value, which is $1. We have to show, even though this result is same as 5, we have to show the working, otherwise we will not get the mark, and we'll multiply it by market price, which is 0.56. Okay, now let's do the cost of capital of preference shares, which is, so let's read the question again. The 5% preference shares have an ex-dividend market value of $0.56 per share and nominal value of $1 per share. The shares are irredeemable, so perpetuity. So we will get 5% dividend for investing the nominal value of $1. So 1 will get 5% every year for investing $1 for nominal value of $1. So we will get this amount of money, 5% on $1 for perpetuity, if we invest $0.56 per share today. So divided by 0.56, 8.93, and total is also automatically calculated. Okay, now let's do the loan notes, which is similar market value calculation. So number of instruments multiplied by market value. So 11, let's read the question. 6% loan notes of Dinla company are currently trading at 95.45 per loan note on an ex interest basis and will be redeemed at the nominal value of $100 per loan notes in 5-year time. So this is not in perpetuity. We will get the nominal value back in 5 years. So let's do the market value first. Loan notes 11 divided by nominal value, which is 100. Usually loan notes nominal value is 100, and multiplied by 95.45. That is our market value of loan notes. Now we can simply calculate the cost of capital, because we have to do IRR calculation. So we have to show working for loan notes. So let's do the working here. So let's see the question. 6% loan notes of Dinla company currently trading as 95.45. Okay, so we'll do IRR calculation. So let's see, years cash flow, year 0, year 1, for how many years? 5 years. 5 years calculate. So okay, so let's read the question. 6% loan notes currently trading at 95.45. so if we invest minus 95.45, so this is our opening value. We will get 6% interest. So this is our opening value. So let's do the second year. We'll get 6% on a nominal value of 100%. So 100 into 6%. However, we also pay attention to corporate tax of 25%. So we can do it by 75%, or we can show the working 100 minus 25%, same, and we can just drag for year 4. Now it will be redeemed at the nominal value of $100 per share, per loan note in 5 year time. So we'll get 100 at the year 5, plus we'll also get interest. So this is the year 5. So now we can calculate the cost of debt using IRR, and we can use the IRR formula, which is IRR. Just select all the cash flows, 6%, or we can take 2 decimal point, 5.57%, and that is our cost of capital by using IRR. So we can just link it and we also have a total answer. So this is how we can easily do the IRR calculation. There is another way I can show you. Okay, so this is an alternate method. This is thus for demonstration purpose. You can just follow this formula, which should be enough. But this is another formula which is using IRR, same, but you have to do a lot of work. You take the year 0 and you do annuity and discounting factor. You do discounting factor for year 1, annuity factor for year 1 to 5, and then discounting factor same. First we take the 5% and 6%. This is you have to guess. You can take 1% and 20% just to be safe, but your KD will not IRR will not be the same. So that's why this is safe, because it saves a lot of time and you don't have to guess the percentage of higher and lower. But this is another method. So first year discounting factor 1, second year you have to take annuity factor, okay, so this is the calculation. Same, 100 into 6% and minus 1 minus 0.25, same calculation. Now annuity factor, you have to use the formula 1 plus r to the power minus n divided by r, and then multiply cash flow into AF or DF, and same for 6%, 1 minus 1 plus to the power n, 1 plus r to the power n divided by r for annuity factor, and multiply year 5. We are just taking 100 because we are taking 4.5 for year 1 to 5, so we don't have to add here like we did here. So discount factor 1 divided by 1 plus r to the power n, or you can do 1 multiplied by 1 plus r to the power minus n, same, multiply, and present value of 5% is this, present value of 6% is 1, and now we can do the KD IRR formula, which is lower plus bracket lower divided by lower minus higher multiplied by higher minus lower. So this is a very complicated formula, but just for showing, you can just use this. This is also correct, and this will save a lot of time. Okay, anyway, just to show this. Okay, now let's go back to the question. Okay, now let's go back to the question here. Bank loan. Let's see. Bank loan has a fixed interest of 7% per year. So bank loan given is 3 million. Book value is same as market value for bank loan, so just write 3, and bank loan is 7%. So this is just 7%, but we also have to take care of the tax rate, which is 25% into 100 minus 25%, and that is our bank loan. And so our calculation is complete almost. Now we can just do the total, which is, we don't have to total of cost of capital because it's in percentage. We just have to total the market value, which is easy sum, and just take it, and also total of total. And now we can just bold it. We can do the work or whatever average cost of capital, and the answer is total of this divided by market value. And you can do the percentage 10 or 9.94. This is the answer. So fairly simple, but you have to be very careful with especially with the cost of capital. You basically have to practice it, and that way you can understand it properly. Okay, that is the answer. So this is 8-mark question. You can do, if you can do this, you will get 8 marks, and rest is theory, so you can do it by yourself. So that's it. Thanks for watching, and good luck.